Hello, I'm Udayan Mukherjee, and today I'm going to talk to you about whether your portfolio should be diversified or concentrated. This is a very common dilemma for most investors. How many stocks should they have in your portfolio? What is a diversified portfolio and what is a concentrated portfolio? Which is better? Is diversification better or is concentration better? Let's start from the top. You'll know that from talking to friends, relatives, other people in the stock market, other investors, that sometimes people go on buying stocks over a long period of time. And suddenly one day they open their portfolio and they see the portfolio has more than 100 stocks. It is not possible for most individuals. I'm not talking about mutual fund managers because investing for them is a full-time job. For most individual investors like you and me, monitoring 100 plus stocks is an impossible task. And what happens is you basically keep on accumulating these stocks over a period of years, and then you lose focus and you lose track of what's going on with these companies, and this is a sure recipe for losing money. And also it's too diversified, the portfolio then. Now imagine you own a good stock and it's 1 out of 100 and it's almost like 1% of your portfolio, but now that stock suddenly doubles. That's gone up 100%. So you would say, oh wow, my portfolio has benefited quite a bit from this doubling of the stock. But all that you've gained in your portfolio is that 1% has gone up to 2% because it was only 1 of 100 stocks. So when stocks in your portfolio go up meaningfully and you want to have some meaningful rub-off on your overall portfolio value, you should have not such a large number of stocks because then the overall portfolio value does not appreciate too much. The converse is also true. Some people take a fancy to one sector, and we saw that in the year 2000 when the whole IT boom was going on. People owned only IT stocks, so one sector, and they did very well for a while. For 1 or 2 years, IT stocks were doing very well, and they owned many 4 or 5 IT companies which did very well. And then there was a bust, and these IT stocks fell 80%, 90%, and your portfolio fell 80 to 90% too. So your 1 crore portfolio became 20 lakhs in a matter of weeks because you owned only one sector, which was IT. That is an equally dangerous thing. It may look good for a while, but it's a very dangerous portfolio ploy to have an extremely concentrated portfolio. But also the other thing to keep in mind is that nothing is good forever in the market. Market has flavor. Sometimes some sector is doing well, at another time something else is doing well. And therefore, you don't want a portfolio which is a one-trick pony, that when that sector goes out of flavor, your portfolio starts underperforming as well. So you want to keep different kinds of stocks in your portfolio. That is the essence of diversification. Because in a particular year, consumer stocks will do well. In another year, IT stocks will do well. In a third year, banking stocks will do well. And you want a portfolio where you have some representation of each of these sectors, the good stocks in most of these sectors, so that when your sector comes back into flavor, those stocks in your portfolio do well and they cover up for the stocks which are not doing very well, which have gone out of favor. The best way to do it, and this is not a sure shot recipe cast in stone, is to have some building blocks in the portfolio. What are the building blocks in India's market? One is consumption, consumer related stocks. One is IT, where they have a large number of stocks. Then you have banking and financials, which is a very large cluster once again. And then you can talk about manufacturing broadly as a class, where you can talk about sectors like chemicals, paints, auto parts, etc. Now, so when you're constructing a portfolio of say 20 odd stocks or 25 stocks, you say, I want a little bit of each of these because I don't know in which year manufacturing will start to do well, in which year IT will do well, and therefore I need to have some of these stocks in my portfolio. And you hunt sector wise and choose the best stocks, and that's a very good thumb rule to do some kind of diversification. Now, diversification is not important only in determining stocks in a portfolio. It is equally important in your overall asset management. Say you have savings of 50 lakh rupees and you watch business channels all day and you want to only buy stocks. But then stock markets go through ups and downs. There are years when the stock market gives you no returns. Sometimes there are big corrections and sometimes it does very well. So like you're choosing different sectors to hedge your bets, similarly with your overall portfolio of 50 lakh rupees or whatever it is, you need to buy different assets. So you say, I'm very bullish on stocks in India. Okay, that's very good. So you put 25 out of the 50 lakhs in your into the stock market, either through mutual funds or through stocks. That leaves you with 25 lakhs else. So you say, I want to be putting some money into safe assets, which will not go down like the stock market in a bad year. And you choose something which we call fixed income. Now, fixed income can be a fixed income mutual fund or bond fund, or it could be a bank fixed deposit, a simple bank fixed deposit. And that the chances of losing money in a bank fixed deposit are far lower. So you have some sense of stability in the portfolio. So you say, I'll put 10-15 lakhs in bank fixed deposits or bond funds, or put together. Then you say, what about my cash needs? What if I suddenly need 5 lakh rupees? So you keep 5 lakh rupees in something which is more liquid, either in a savings account or in a liquid fund or something like that, which can be redeemed overnight. And then there are some other asset classes like, say, gold or property, where you put a little bit of money as well. So you have a diversified portfolio with a greater leaning towards stocks if you are so inclined. But given how different asset classes do in different years, you will actually have a far more balanced approach to your portfolio. So diversification of a certain kind is important, and I would say that the optimum number of stocks, or the sweet spot in a portfolio, is probably something like 25 to 30 stocks, which gives you some concentration. It's not like 100 stocks, yet it gives you an adequate diversification. So choose your number. Maybe for some the comfort number is 25, for some it is 30, but not more than 30 if you can help it, and not less than 20 if you can help it. Hope that was helpful.
If you like the video, do like, comment, share and subscribe.